enormous creations of debt and printing of money to monetize that debt in the world's major reserve currencies. The second is internal conflicts due to large wealth and values differences that are producing populism of the left and populism of the right, and this great conflict that is political and social that is going on in the United States and in a number of countries. And the third is a great power competition between the United States and the American world order, which was started in 1945, that American world order, and the rise of China and other powers to be comparable in power and to compete with those powers. And in order to see those things, even to examine wars, different types of wars, I don't mean just military wars. There are 5 different types of wars. There's a trade war, a technology war, a geopolitical war for influence, and a economic and capital war, and then there's a military war. And through history, there have been. And to see those through history, those things, I needed to study the last 500 years because they're the sort of things that come along once in a lifetime. And so I did that study. And then in completing that study, I decided to put it out as a book because I think it's important for people to have the opportunity to review it.
Actually, let me double click on the second point you try to make, the increased gap between the have and have-nots. So let's looking at historically, how bad we are today.
We have the largest wealth gaps in the United States, and they're also true in Europe, but particularly in the United States. And there's large wealth gaps in China too, but there's large, that is the largest since the 1930 to 45 period. And to put that in perspective, the top 1/10 of 1% of the population's wealth is equal to about the bottom 90% combined. So they're large wealth gaps. They create also opportunity gaps because wealthy people have greater opportunity to not just themselves, but to raise their children and give them benefits. And that's a classic source of problems when there is economic tensions and external tensions as there are now. So it is the basis of populism. And so traditionally populists, who are people who will fight for that population, that type of populism comes when those gaps in wealth and values are large. So that's what we saw, and it's very typical.
Yeah. And then, coming to the point of massive printing of money, how do we, look ourselves compare with the historical times when there is excessive, on liquidity?
Well, over a period of time, the cycle, there's a big cycle. I could describe the cycle to you if you're interested, but there's a big.
Would love to.
There's a big cycle. Okay, I'll describe the cycle to you. We go from one world order to another world order, usually because there's a war that resolves the conflict. So the great cycle, for example, World War II, had winners, and those winners, then particularly the United States, had much greater dominance in power than the rest, and they get to set the rules of the game, which we call the world order. So in the United States, for example, in 1945, after the world established pretty much the world order because the United States had 90% of the world's gold, and gold was money. It had half the world's GDP, and it had a dominance in military power. And so there's a development of that new world order. That's why, for example, the United Nations is in New York, and the World Bank and the IMF are in Washington, D.C., and it had a dominant currency. And as a result of that, you have a period of peace and prosperity because no one wants to fight the dominant world power. And over that period of time, and when you have a reserve currency, others want to save in that reserve currency because that's the currency that is commonly spent. And that results in that saving is lending to the country. And you also see that increasingly, as peace and prosperity take place, individuals and companies are more inclined to take on debt and bet on the future. And so you see that the debts rise relative to GDP. And there's always, whenever there's a downturn, there's a stimulation, give credit, because that gives buying power. And when you give the buying power, that causes things to go up. And as a natural cycle, as wealth is accumulated, it's accumulated unevenly. Some people make a lot of money and others don't. And that's just part of the nature of the system. But that also creates not only wealth gaps, but it creates unequal opportunities, because those of the rich have greater opportunities than those of the poor. And as a result, of course, at the same time, the power of the leading world economy, the leading world power, declines relative to emerging countries, because as other countries recover from the war and become stronger, then that gap in power begins to narrow. And so you see that international gap, these phases where there's then quite a bit of debt and not as much money, not as much hard money like gold, not as much money. And you have this internal conflict. That internal conflict and the money issue becomes a political problem that causes this greater polarization. And so you come into a period prior to these military wars, you come in where there are these competitions, the 5 kinds of wars that I mentioned before, the trade war, the technology war, the geopolitical war, the economic and capital war, and that. And then traditionally, as that conflict becomes greater internationally, you see those economic wars intensify. For example, sanctions are not a new thing. In other words, economic and monetary and capital sanctions are not a new thing. They happen throughout history. For example, leading up to World War II, Japanese assets were frozen by the United States, and oil imports were curtailed by the United States. And because of those economic pain, it led to the bombing of Pearl Harbor and the military. So, and then you have that war. Again, because there's no world court. And then when you have the war, then you have a dominant power that sets the rules and you do it again. And that pattern has existed throughout history. So one could see that big arc in the cycle. And so by looking at what's actually happening with thinking about that big arc, it's helpful. For example, right now, the January 6th attack on the Capitol, essentially by populists of the right, which are very similar to fascists in World War II, that move was very much in line with that. And we are in a political situation in the United States where it's conceivable that in elections, neither side will accept losing. And we're seeing the breakups, questions of rule of law. For example, will the Supreme Court decisions be followed or will they not be followed? And so it's a threat to that system. So there's a typical cycle. And then by knowing what that arc of that cycle is, and then by watching what is happening day by day, you can match the two up. It's not predestined, but it gives a very good frame of reference, for example, in understanding today what is happening with economic sanctions and where that might lead.
Yeah, these are very interesting observations. So let's look at numbers, right? The Fed balance sheet has ballooned from $1 trillion in 2008 to $4 trillion in 2020 and to $9 trillion in 2021. So $5 trillion of US dollar balance sheet was created just in 1 year. Now, almost all central banks in the US, in Europe, are aggressively raising interest rates simultaneously. At the same time, we have geopolitical conflicts and pandemic. All tail events are happening at the same time with magnitude unseen. So what kind of tail risk do you see out there to happen in the financial market?
I like to explain it mechanistically. So what happened was there wasn't enough money. And in history, money used to be hard, gold or silver in China. And when the coffers were empty and there's not enough money, there would be the printing of money. Because that was, where do you get the money from? You either have to take it from somebody, and that's a fight, or you print the money. And then so that's what you have seen a lot. Where did the checks come from to pay for all that has been paid for? It produced the printing of money. That causes the value of money to go down in relationship to goods and services, and that causes the inflation rate to rise. Okay, so inflation rate rising takes buying power away from people. It reduces their wealth in real terms. And so even when we think of what is a safe investment, people think that holding cash is a safe investment, or maybe even holding a secure bond, like a government bond. But they learn through this, no longer. They learn from that experience that they're taxed very high in form of inflation. So they want to move out of that. And at the same time, the government wants to fight inflation. But what is the way they fight inflation? They take away buying power that they gave in order to fight inflation. So what they do is first of all, prices are going up. And then in order to fight it, they say, I'm going to take away your spending power at the same time prices are going up, because they remove liquidity, like the Federal Reserve will sell $1.1 trillion in bonds, and they have interest rates going up, and that takes away buying power. So they produce a stagflation environment in which you're, in a sense, one is suffering from both ends. One's losing buying power from both ends. So that's where we are in the cycle. Very, 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 very classic. The only way you can raise living standards is by producing more. You can't raise living standards by making money and credit. You can, because credit has got to be paid back. And since one man's debts are another man's assets, you have to make that balance appropriately. Otherwise, you have a problem. And that's the problem. When you have a lot of debt, it's very difficult to make debtors and creditors have an acceptable set of circumstances. We've been in a situation, and we are still in a situation, in which those who are lenders and own the debt instruments will get taxed very heavily. So the rise in interest rates will not be high enough to curtail the inflation or to reimburse holders of those assets for the rate of inflation without having a negative effect on economic activity. Hence, that's why the mechanics of stagflation work as they do.
You clearly have done some very interesting researches. Are these researches, and including obviously, the content in this book, largely come from quantitative analysis, or this is more like instant? Do you have many tools like the data analytics or the AI kind of type of algorithm supporting your research?
Yes, it's so important to have good measurements, so that you see through the book, you see many charts, many reflections, because objectifiably measuring is the only way that one can be clear and measure, and the only way that one can build models for measuring what's happening, but also for anticipating what comes next. Because everything that happens has causes that precede it. And by understanding those cause-effect relationships and managing and measuring them over time, one can then create these models for understanding that. And these things repeat over periods of time for logical reasons. For example, when you print a lot of money, it leads to a higher level of inflation. And when you have a higher level of inflation, it leads to a tighter monetary policy. And by being able to measure those things in their degrees, and then you can know how the dominoes will fall. That's what I do and bet on. It's not theoretical.
Yeah.
I mean, that's what we've been doing. I've been doing it in varying ways for the last 50 years of the past. It has a purpose, which is to make a correct bet.
Yeah, it's a combination of basic business instinct plus obviously a lot of data supporting that. Right? I mean
it's like a doctor seeing many cases. When you see many cases over and over again, you know how the cases typically
you see the patterns
transpire, and you see the cause-effect relationships between those patterns.
Yeah. In other words, there are some big data factor here. Okay. So here's a question from the Douyin audience. So based on the economic trends and the conditions we just discussed, what is your advice on the investment strategy for the future? Ray?
Well, of course, it depends where one is investing and where one can invest. But generally speaking, for the world, cash investments, in other words, short-term or longer-term government debt and debt in general, will have a negative real return. In other words, after inflation. So one does not want to own those assets. And then it's very important to have a diversified portfolio of investments. And that means balance. We have a strategy, which we call an all-weather strategy, which is based on balancing different asset classes, because wealth is like, think of it almost, if it contracts somewhere, then it rises somewhere else. So for example, in an inflation environment, then you have commodities, gold, other inflation assets that will compensate for the negative returns of other assets. So by starting with a balanced portfolio, that's very important, because when you achieve effective diversification, you can maintain an excellent return with much less risk, because you can put in assets that have about equally expected returns, but diversify each other. And so next, don't be in cash in those assets. Second, be well diversified in a way that produces that balance. And then third, if you're a global investor, and I'm a global investor, to be diversified between locations and countries and then industries.
So you're talking about diversifications across different asset class and across, obviously, different country. Specifically on different asset class, can you share a little bit more, in details, what are the sort of major category investor in China or any, investor, global investor should actually have exposure to?
Well, the way I think about it is like a quadrant of 4 boxes with 2 main influences. The 2 main influences are inflation and growth, and they can rise or they can decline. So think of a 4 boxes square. On the top it says inflation, other one says growth, the other one says down or up. And if you think, what assets would I like to own if I was in either of those environments? and you put 25% of your risk in each one of those environments. So for example, if growth is faster than expected, that's the first quadrant. Let's say growth, arrow up, faster than expected. You would like to own equities, and you would like to own credit spreads, because when that condition exists, credit spreads come down and equities go up, and that's what you would like. If you go to the other box, well, let's go down this box. If growth is falling, what would you like to own? You would like to then own assets that do well when growth is weaker than expected, and so on. Then you would like to own bonds, high quality bonds, typically. If you go to the upper right-hand corner and you say, what do you want to own if inflation is stronger than expected? Then you would want to own inflation hedge assets. It would be commodities, it could be gold, it could be inflation index bonds, those kinds of assets. And you do the same with the, what do you do if inflation is less? And that kind of quadrant says, that's a guide to balance, how you achieve balance. And you want to risk balance those things, because being conscious of the fact that, let's say bonds are less volatile than stocks. So if you put the same amount of dollars in stocks and bonds, then you're going to have more volatility in equities than you have in bonds. So you want to risk balance those. That's a very quick and probably inadequate explanation of achieving balance to start with. Then once you have that balance, you're like a ninja, you're balanced. That means that no matter what happens, you have that balance without and you have your risk under control, just by nature of that balance. And then you make tactical moves depending on the change of the environment. So for example, and this is timeless and truthful all around the world. For example, when you have pressure in China of weaker growth, and you have economic activity slowing, there is a pressure to lower interest rates, tends to bring down the interest rates, and tends to not be good for equities. So that dynamic means that you could imagine how that balanced portfolio then adjusts. So that, and if it comes with higher inflation, so for example, in our investments in China, we've done very well because of that balance. So even though equities go down, what's happened is the inflation hedge part of it has done very well. And the bond part of it, or the credit part of it, is doing very well. And so we are able to achieve that balance, and then we make tactical moves from that balance. So Neil, you've asked me a lot of questions, but I'm so curious about your perspective, because you and Sequoia have been the backbone of a lot of private investment in China. So you get to see it up close. Can you tell me what it's like now, what the circumstances are, what the opportunities are?
Thanks, Ray. We're very lucky to partner with many amazing entrepreneurs and create great value for investors. Along the way, we made a lot of mistakes, and we have been trying to learn from these mistakes. There were failures coming out of technology risks. There are failures coming out of bad executions. There are also public market volatility, which affect investment returns. And we need to have, I would say, a heart of all. To many people, we're in the financial service business, looking after assets, but we are really in the people business, both internally and externally. Internally, we provide our team member some great career opportunities based on their strengths, their interests, and we learn and grow as a team. Externally, we have some different mentality from the public investors. our position are really come down to one word: serve. We serve our entrepreneurs, and the way how we work with them will determine a good part of our results, and also it will establish our brand and reputation. The approaches of venture and growth investment, which are the main product for us, from this perspective, are different from hedge fund investors or traditional buyout investors. Like I said, we as venture and growth investors are mostly focusing on tech sectors. One thing I feel I'm a little bit lucky, as I listen to your description of the macro environment, because macro environment does not matter that much to us. Business certainly will be negatively affected because of challenging macro conditions, but the technology development do have its own cycles. For example, over the last decade, with safety improved, with cost coming down, the lithium power battery is able to be used in electronic vehicles as well as in power storage with large scale, not only in China, but also globally. The timing of such technology breakthrough has not much to do with the ups and downs of the economy. It requires completely different skill sets to predict an emerging tech trend, which is exactly the critical part of our jobs.
I'm just curious about pricing. A lot of liquidity raises all boats, and taking away liquidity lowers all boats. Are you finding that it has been expensive to buy assets when there was a lot of liquidity? And are you finding that the reductions of liquidity is having an effect the way it is having on other tech companies around the world?
I think that's a very, very good question. In fact, indeed, I think, in the last 5 years, most of the time we see a lot of liquidity, not only in China, but also in other part of the world, especially in the tech space. And because of that, the valuation for the investor get a lot expensive. Second, the companies have received more money probably they would have been receive, and so the competition also getting more fierce. But luckily, in the last 6 to 9 months, globally, you're seeing actually the tech market has more subdued, and we're actually seeing the first time that the investor is able to get a more reasonable valuation with those private companies. And frankly, because of that, the competition among the tech company themselves are getting more rational. I hope this will lead to obviously a more healthy environment for tech innovation as well as for investors from a return perspective.
We have a question from the Douyin audience about changes. Technology changes happen so fast. The question is, how do you possibly deal with these changes? In other words, you make an investment and before you know it, there's another technology investment. And how do you remain mobile in a more illiquid market? And how do you grab the best ones and go with it when the technology is changing so much?
I think that's a great question, Ray. I think, and that's also a question we actually ask ourselves every day. And the answer is that we need to adapt ourselves to the fast changing tech market. We need to go through learning curves on any emerging new technology. And we need to do that as quickly as possible to be ahead of the competition. Like you suggested, I think the next decade could be dramatically different from the last decade in your business. Same for us. What has worked before most likely will not work in the new era. In order for us to adapt effectively, we should have a flat organization structure and a decision-making mechanism which is effective. And this is very much like the setup of some of our very successful tech, portfolio companies. At the same time, it's important to adopt a consistent strategy with a long-term view of the market, because the tech market goes up and down significantly.
like what we saw over the last 1 year or so. But if you believe the potential of these tech innovations, whether in the new energy areas or in synthetic biology areas or in biotech, you need to stick your neck out, especially during tough times. And you should continue to invest, and you continue to help them to navigate through obstacles and try to achieve their dreams in building great companies. Our portfolio CEO would love to find a board member and a long-term shareholder who have such consistency in their approach. Lastly, I need to love my business. For me personally, I have been genuinely interested in these tech trends and the themes that has created new product for human beings. When I read those research memos from a team and participate in the discussion, it kind of brings me back to my university days when I'm working on a new science or engineering subject. Actually, you have some similar sets of questions. Why, what, and how? The analytical approach are also very comparable. So a engineering and scientific training background have to be very, very helpful in our business for tech investing. I really have enjoyed that learning process and very, very curious to find answers, just like you, through data and fact. You have been in China many times, if I understand, correctly. So what's your impression, let's say back 20 years ago when you were in China versus, I guess, your last trip in China, maybe 3 years ago? We'd love to hear, your perspectives.
Oh, well, when I came at first, 1984, China was an entirely different place. So I was the guest of CITIC, which was to teach them about the financial markets because China just opened up. 1978, Deng Xiaoping opened up, and I was invited in 1984 when CITIC was the only window company to deal with the outside world. And there were no cars, there were bicycles. People took naps in the middle of the day. It was mostly lived in hutongs, very undeveloped conditions and so on, but always very clearly smart, not like a developing country mentality, very smart, great potential. But I'll give you an idea. I would give $10 calculators to people as gifts, and they never saw those calculators before, and they thought that they were miracle devices. And now today, whether it's AI or quantum computing, you have that kind of technology development in China. So I got to participate in even the development of the first stock market and the financial market since. There was a group of 7 people. It was called the Securities Exchange Executive Council, 7 people, and they were in a hotel room because they didn't have offices then. And there was a dingy hotel, and they hadn't hardly any resources, and they were building the first stock market. So it was a kick for me. Now, I didn't earn any money. They didn't give me a dime. On the contrary, I helped to support them. And we would build the first stock market and to see that develop. Now you have the second largest capital markets in the world. Since I came to China, per capita income has increased by 26 times. The life expectancy has increased by 10 years. The poverty rate, the hunger poverty rate, has gone from 88% to less than 1%. And I'm watching a vibrancy that you're seeing and that you're experiencing throughout the country. And so it's evolved that way. And at the same time, the world is changing because, as I say, China now is, a roughly comparable power, all things considered, in many ways. But of course, there needs to be a lot of great development in China still, because there's large populations that are in areas in the country. But still, it's quite amazing. And so I got to see that. And I got to work over the period of time with the evolution. So I've seen the most amazing changes. I've seen, I think it's the greatest economic revolution progress that has ever existed. I mean, essentially 1.3 billion people changing at that rate and seeing it. I think that it's almost a shame that younger people who haven't seen that whole thing may not fully appreciate the magnitudes of the developments. And it's a struggle to get that all right. So yes, that's what it looks like to me.
Well, great. I think indeed it has been amazing development. I think in the last 40 plus years, and I'm so happy for you because you are not only an observer, but you have been part of it and you have been participated deeply, and that's make it even more wonderful.
Think about how wonderful it was for me. It's a joy.
My very last question, because you mentioned obviously you want diversification across different regions and countries. So obviously US is important and China is also very, very important. What will be the third country or region you're going to pick if you want to have your fund or have the asset diversification to have exposure to?
I'm looking at three things now, and they relate to the three concerns I have. The first is the country financially stable? Meaning, does it earn more than it spends? So does it have a good income statement and a balance sheet? Does it have internal conflict that could be disruptive, or is it orderly? And does it have a risk of an external war of something that's disruptive? And so the countries, generally speaking, that also have appeal that way, where they're developing technologies and so on, are the ASEAN countries. In other words, a number of countries in that region, in Southeast Asia and so on, India, and also the Middle East is developing very interesting ways, particularly, let's say, Saudi Arabia and Abu Dhabi and some of the areas in the Middle East, because they have the financial resources and their circumstances are changing in terms of internal conflict. So exposures in those areas are interesting to me. Neil, we've been talking about investments, but one of the most important things is building investment teams, because we can't do it ourselves, and the culture that you build is so important. And so we each have built our investment teams, and we've done it over a long period of time. So tell me, what is it, in your opinion, that's the most important aspects of leadership and team building?
I think it's a very good question. And frankly, I think I'm still in the learning curve. But indeed, in the last 17 years, we have seen our team has grown. I think it's important for the leader of the firm, first of all, to be a good investor himself or herself. I think that's critical. Second, I think investment is really about learning something together as a team. And I feel it's extremely important that you're able to share your experience, even including those failures, together with the team, because we learn so much from those failures. Thirdly, I think you need to build a strong analytical capability internally. Like you just mentioned, I think when you do those amazing research, I'm pretty sure you have some very strong tech tools behind the scene, so that you enable the investors to best leverage the resources that we have. Lastly, I would think that it's really a platform to encourage the young investors to really developing his or her skills based on their own interests. Because this is like something like an artist, right? You need to do something which really interests you, which inspires you. You cannot force someone to do something
or to train to himself or herself to do something which is boring because he or she cannot be successful. So I saw these are probably some of the sort of experience I have gone through. I mean, you have built Bridgewater into some the very, very top global investment firm, and I'd love to hear from you how you built that.
I'm just touching on some of the things that they overlap with yours, but the most important thing I think is excellence and continuity. And what it really means is meaningful work and meaningful relationships, or excellent work and excellent relationships, that they complement each other, that you're on a mission with the best of the best to be able to achieve something, and that those relationships between the people are binding. They bind them together on that mission. So I have one sentence. It's a long sentence that describes it. I want an idea meritocracy.
Meritocracy.
I want the best ideas to win out wherever they come from, not hierarchical, the best ideas to win out. So I want an idea meritocracy in which the goals are meaningful work and meaningful relationships. In other words, that combination of we're in it together and we have that esprit de corps. And so idea meritocracy where the goals are meaningful work and meaningful relationships through radical truthfulness and radical transparency. And what I mean by that is the ability to talk about everything in a totally truthful way. The strengths, the weaknesses, the mistakes. You talked earlier about mistakes. The ability to say who is good at what aspects and who is not as good, and how do we deal with mistakes and all of that. That's what served me the best. And I think you also touched on it. As the organization changes, the communication and the continuity is something important to manage. I know I went from, two people. I started it in my apartment. The second, I had 2 bedrooms, and out of 1 bedroom, I started it. And then we ended up with 1,500 people. So as you move from one stage of an organization to another stage of an organization, to keep that continuity and that mission together. And I found that it's very important to write down principles. What I'd always did is that whenever I would make decisions, I would write down the principles that I'm making the decisions, whether those are investment principles or whether they're management principles. They're like recipes, and you could read them. Here's my recipe for making that decision. And I found that we could then automate those with algorithms and that would take in the data and make the decisions for us simultaneously. But that kind of communication of what is best and how it works, because culture is destiny. In other words, what your people are like, and they will be different in how you take care of those differences to make them complementary. What your people are like, plus how you are with each other, will determine the degree of success. So I found those things to be most important.
Very, very insightful, Ray. I think meritocracy is also the number 1 tenet at the Sequoia. And you talk about the recipe, and you obviously have this this book written over the last I guess probably 5 to 10 years. Those principles. I think these are very helpful. I think not only obviously to our own team members, but to the broader investment community. One question
I just at one point on principles, I would want to recommend it for your audience, for the audience, and for each other. That I learned another principle: pain plus reflection equals progress. Quality reflecting on and writing it down, the principles, what happened, how does reality work, and then writing that down in a principle makes you think more deeply about it, can allow you to automate that process, and allows you to communicate effectively with others that you're working with. So those recipes are important. Think about the talent that you're bringing and the criteria in your decision making. And if you don't write them down, you won't pass them along. You won't stress test them. You won't collectively look at the criteria you're using. So I found that writing down principles is very helpful, and I recommend it to everyone.
Great. And you talk about communications, and you obviously, this is a critical part of building a culture internally. So my question here is that given COVID in the last 2.5 years, how our business has changed, you think, given that it's mostly actually through video communications and meetings like this instead of in person. Do you feel this actually has negatively affect so-called internal communications as well as external communications with your partners and or limited partners, etc.?
It brings benefits and detriments. It brings benefits in some ways that people they don't have to commute in the same way. They have certain freedoms, certain efficiencies are gained, and so on. And it brings detriments into not having that warm personal interaction. And of course, it very much depends on the specific jobs that people are doing. So the ability to have a choice is a good thing. The way that we're dealing with it is we have required 2 days a week, we bring people in, and those 2 days
in person.
And those 2 days are focused on that kind of interaction type of things. In other words, there's two different kinds of work. The work that you don't need to be in person to do, and the work that's especially advantageous. And it may not just be work, it may be just the quality of the interaction. And so we emphasize during those 2 days, that kind of work, that kind of interaction that brings people closer, at the same time as we then focus in on the other things that exists when we're out the other 3 days, so that there are swing periods of time. And then depending on the job or the preference, the person can come in 3 days, or, we work it out on that individual basis. And we find out that, that's good. So, you have to take the good and the bad. You have to know how to deal with them and balance them. And that's how we found it works best.
Yeah, we're all adapting ourselves to this, really, new environment. So back to the question we discussed about, identifying new market, which is, important, right? And you talk about, Southeast Asia, potentially, India, etc. So when you look at those markets, examining its opportunities, are you going to visit these countries in person? How are you able to form your view? What kind of data and what kind of sort of information you are relying on to come up with, your conclusion?
3 things: the data, the impersonal, and the triangulation with the best of the best in that area. So, yes, there's a picture. I've been a global macro investor for more than 50 years. And so through data and so on, I can learn a lot about how the place works, of course, but not enough. Then there are those people like you, for example, who are on the ground and have understanding and intimacy. And there's a fair number of those types of people who you have contact with, and you get the triangulation. And that's a very quick way to get an idea of what's going on in the place. And then you do need the direct contact. So all 3 of those are important.
Great. And coming back to the China side of your business, obviously, China so well, but I know that you have been building a domestic team in China and having a domestic product. How those strategies will be different from your global strategies?
Yes. So we have 2 offices in China, one in Shanghai and one in Beijing. We have an investment team. And for about the last 3 years, we have been investing onshore for Chinese investors in China. But we've known the markets very well. As I say, even there, to some extent, I've helped to play a role in the development of those. There are First of all, there are timeless and universal rules that exist all through all countries. In other words, when
Those same recipes.
the same type of recipes, like that 4 boxes that I gave the example. If inflation rises and growth is discounted, blah, 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 those things will behave that way, because in all countries, an investment is a lump sum payment for a future cash flow. And you take the discount rate and what the future cash flow is, and you can come up. That's a timeless and universal truth. So we have these timeless and universal rules that we apply through all countries, and that's our starting point. And then we get immersed deeply in what's going on there. For example, policy changes in China in certain ways play a much more important role than they might play in some other country in terms of that direction. So how do you take into consideration that? Or you have to get down to a very granular level. How does the money flow? Who is buying what and for what reasons? Those kinds of things become very granular and local. But the way that we approach them is analogous. It's probably the same way you're approaching your private equity investments in China versus elsewhere. You know, okay, there's still the criteria. What are the managers like? What are the, balance sheets, income statements, where it is? And so it's that kind of an approach that we take. The fact is that for most of it, the timeless and universal rules help. And I imagine the same was true from you all, that before you came to China, in a sense, there was a sense, Sequoia has a sense of investing. How do you do that well? And then you bring it to the local environment. Has that been the case?
Yeah, I very much agree. I think, when we look at our, business, whether it's in the US or whether it's in China or in Europe for that purpose, the very leading tech companies share some similar characteristics. Even actually, you can find similar traits among the top CEOs. And when you look at the business models, actually, the successful one oftentimes also carries some common features. Like, for example, we have this one common theme called the software is eating the world. Now, in the US, there has been a long list of successful software SaaS company sort of companies are moving to cloud. And it's happening in China, probably 3 to 5 years behind US, but that thesis very much is the same. And when you're looking at those SaaS companies, you can look at the same sets of parameters and make very much the same type of rules in terms of how you price those companies. And this is something which I find very interesting. And today there's another element to that, which is the US company, some of those could be successful in launch their product in Europe or in China, and vice versa. The Chinese company today, increasingly more, could actually have their product selling successfully to US and Europe, so that it's the same competitiveness which is drive those success. If you a Chinese company in the software space, you need to be successful. You have to be on the equal foot from a product competitive perspective, compared with the US counterparts.
It's similar. The building of our cultures is similar, and the selection of investments and how we do it with the timeless and universal rules and the local knowledge is similar.
Yeah, I feel like it's so exciting to hear from you, because we are in the venture and growth investment. We also have some buyout, but you obviously mostly public market across all different asset class. But I found actually the investment principles are so much similar, and and when you come down to build a financial service company, an investment firm, there's so many common to share, from a culture, from a team building perspective.
I know that we're running out of time, and I want to continue this conversation, focusing also on the differences, for example, liquidity versus illiquidity. because that's the thing where the real differences are.
Exactly.
And the education would be there. Like in my case, it's easy to change my mind, and I can be flexible and adaptable. In your case, you are really business partners with the entities that you're supporting, and you can change your mind. So
Exactly.
And that's a different story. So that's tantalizing for me to continue this conversation. And so whether we do it in person or maybe do it again like we're doing it now, I hope that we'll continue it. And I think we're going to get close to being able to do that with maybe not so much of a hurdle.